Hi, Shari Okamoto with Caliber Real Estate Group here with the September 25th market report. Unemployment numbers are slowly declining month to month. They're down to 8.4% in August, which was at 10.2% in July. So we've seen a steady decline, which is fantastic. It's not where we want to be, obviously. We were at 4.4% unemployment in March when all of this started. So obviously we're not back to where we want to be, but the steady decline is promising. And if you look at it in retrospect to the Great Depression, which was the unemployment higher than 9% lasted for 108 months. We're at four months in right now. Great Recession lasted for 30 months, the 1980s oil recession for 19 months. So looking at some of the other economic downturns, we're not nearly as bad as they were back then. Unemployment projections. So what they're saying is it's probably going to take us to 2023 to get back to that 4% number that we were at in March. So it's going to take a couple of years, but a steady decline each year going forward. Housing prices. So we put this chart up, and this is all of the different experts in the field of what they were projecting for the next 12 months. And this has changed. So now Fannie Mae is projecting 4.4%, and the only one that is projecting a decline is House, and that's at a 1.1% decline. But as you can see, everybody else is looking at a increase anywhere from 0.6 to 4.4% over the next 12 months. This is the chart that had Fannie Mae at only 0.4%, and now they're up 4%. Zillow had basically a 3-point swing, saying going from negative 3% to 3.6%, and CoreLogic also had that same 6% swing. So as unemployment is getting better, the economy is recovering, you can see that the experts are projecting that the housing market is going to do a little bit better than they were thinking a month or so ago, which is positive. And that is due in partly to the buyer demand. As you can see, showings in the West is the blue one, and that's up tremendously from where we were in March, even up from where we were at the beginning of the year. That coupled with the low inventory, which you can see California is down 41.6% year over year in the number of houses available to sell. So the low interest rates, high buyer activity, low inventory is helping to push those prices up. And even with the prices going up, housing affordability today is still better than it was back to 2017, really. 2016 housing affordability was a little bit better than we are right now, but you have to remember that we're not just looking at the prices, we're looking at the interest rates, we're looking at median wages. So housing affordability is actually higher than it was the last 3 years. And if you look at what a payment was, let's say you bought at $250 at 3.73%, that house is going to cost, that same house is going to cost more, but with lower interest rates, you're saving $61 a month. And if you put that in California terms, so this is for the city of Orange, based on the average prices in August of last year, which was $700 in the city of Orange. And if you bought that at the same 3.73 rate, your payment would have been $32.34. You bought at $750 this year with an interest rate of 2.87%, and your payment is $3,100. So a savings of $124 versus last year. So even though people are nervous because prices are higher, you're still saving money because of the low interest rates. If you have any questions, the fall buyers and sellers guides are out. They're up on our website, so you can go there to get them if you have any questions. If you have any questions about your home specifically, feel free to reach out to us. We're happy to help always. Hope you're staying safe and hope you're doing well. Thanks so much.